There is a market valued at $600 trillion that remains poorly understood by the public. This same market was instrumental in the near collapse of the global economy in 2008. Today, it is 10 times larger than it was then. In 2003, investor Warren Buffett identified derivatives as financial weapons of mass destruction. His assessment proved to be accurate. These instruments precipitated the failure of Lehman Brothers, necessitated the public bailout of AIG, and brought the entire banking system to the brink of insolvency. The official response to that crisis was not to eliminate these instruments or even reduce their scale. It was to oversee their expansion. Today, the derivatives market is valued at more than 6 times the entire global economy. When this market experiences its next systemic failure, analysis shows there will not be enough capital in the world to finance a bailout. Most people have never heard of derivatives. A significant number of professional investors struggle to articulate their precise function. Yet these complex financial instruments now underpin the operations of every major bank, pension fund, insurance company, and government bond market on Earth. In theory, they exist to reduce risk, allowing institutions to hedge against potential losses. In practice, they multiply risk by creating leverage upon leverage. Wagers are stacked on top of other wagers until the chain of obligations becomes opaque, and no one can determine who owes what to whom. This is the identified point of systemic collapse. In 2008, preventing a total financial meltdown required $29 trillion in global bailouts and guarantees. The derivatives market at that time was estimated at $60 trillion. Today, that market is $600 trillion. When this structure fails, the impact will be global, immediate, and, according to all available models, unstoppable. An examination of the data shows why the next financial crisis will not be a repeat of 2008. It will be demonstrably worse. To understand the danger, one must first understand what a derivative is. A derivative is a financial contract whose value is derived from an underlying asset. This definition seems simple, but the underlying asset can be anything: a stock, a bond, a commodity, an interest rate, a currency's exchange rate, or even abstract concepts like the weather or the probability of a company defaulting on its debt. Crucially, the derivative does not require the holder to own the underlying asset. The holder is merely betting on the direction of its price movement. This is analogous to buying an insurance policy on a neighbor's house. The buyer doesn't own the house. They just collect a payout if it burns down. That is a derivative. The most common types are known as futures, options, swaps, and forwards. A futures contract allows a bet on the price of oil, gold, or wheat at a future date, without the need to buy or store any physical barrels or bushels. An option grants the right, but not the obligation, to buy or sell an asset at a specific price. A swap is an agreement to exchange cash flows, such as trading a fixed interest rate payment for a variable one. Forwards are customized contracts, negotiated privately between two parties, to buy or sell an asset at a future date for a price set today. Each of these can be a useful, legitimate tool for hedging. A farmer might use a futures contract to lock in a sale price for wheat before harvest, protecting against a price drop. An airline might use derivatives to hedge against the risk of rising fuel prices. A corporation with debt in multiple currencies might use swaps to manage its exchange rate risk. But the evidence shows the derivatives market is not dominated by farmers hedging wheat. It is dominated by banks, using borrowed money to make leveraged bets on interest rates, credit risk, and currency movements. This is the central point of failure. The notional value of a derivative represents the face value of the asset it's tied to. The actual money put up as collateral is usually a small fraction of this amount. If a bank enters a $100 million interest rate swap, the notional value is $100 million, but the bank might only be required to post $1 million in collateral. This constitutes 100-to-1 leverage. If the bet moves 1% against the bank, its collateral is wiped out. A 2% move means the bank owes money it does not have. Multiply this by thousands of contracts across dozens of banks, and the result is a system where a small market movement can trigger a cascade of institutional failures. The next problem is complexity. Modern derivatives are engineered to be so complicated that even their own creators cannot fully predict their behavior under market stress. Credit default swaps, CDS, a key instrument in the 2008 crisis, were marketed as insurance against bond defaults. In practice, they became a vehicle for side bets, allowing investors who did not own the underlying bonds to gamble on whether they would fail. AIG, the insurance giant, sold hundreds of billions of dollars worth of these CDS contracts, reportedly without setting aside sufficient capital to pay out claims if the underlying mortgages defaulted. When the housing market crashed, AIG's liabilities exceeded its capital. The U.S. government was forced to inject $180 billion to prevent AIG from collapsing and taking its counterparties, every major bank, with it. But the most dangerous feature of derivatives is counterparty risk, which spreads contagion through the system. If Bank A owes Bank B money on a derivative contract and Bank A fails, Bank B does not get paid. Now, Bank B may be unable to pay Bank C, and Bank C cannot pay Bank D. The failure of one institution cascades through the network in a matter of hours. This is precisely what happened in 2008 when Lehman Brothers collapsed. Lehman held over $35 trillion in derivative contracts at the time of its bankruptcy. Every institution that had traded with Lehman suddenly faced uncollateralized losses. Some of those institutions could not absorb the hit and required bailouts. Others survived, but immediately froze lending to anyone they didn't trust, seizing up the credit markets and turning a financial sector crisis into a global economic recession. The clear lesson from 2008 should have been to ban or severely limit these instruments, particularly the naked credit default swaps where bets are placed on bonds the bettor does not own. Instead, the Dodd-Frank Act of 2010 created new reporting requirements and moved some standardized derivatives onto central clearinghouses. It did not, however, reduce the total size of the market. Banks argued to regulators that derivatives were essential for managing risk and providing liquidity. The record shows regulators accepted these arguments, or were neutralized by industry lobbying. The result is that the derivatives market did not shrink after 2008. It grew from $60 trillion to its current level of over $600 trillion. To understand why $600 trillion in derivatives poses a systemic threat, one must re-examine the 2008 crisis, when the market was only $60 trillion. The crisis did not begin with derivatives. It began with subprime mortgages, bundled into mortgage-backed securities and sold to investors. Derivatives were the mechanism that amplified this housing bubble into a global catastrophe. Banks didn't just hold mortgages, they used them as a foundation to create complex derivatives, multiplying profits on the way up and losses on the way down. Lehman Brothers was the fourth largest investment bank in America when it failed in September 2008. Its balance sheet reported assets of $639 billion against liabilities of $613 billion, making it appear solvent. The real danger was in the footnotes over $35 trillion in notional derivative exposure. These were not assets. They were bets Lehman had made with counterparties. Most were interest rate swaps and credit derivatives tied to the mortgage market. When housing prices began to fall in 2007, These derivatives lost value. Lehman's counterparties demanded more collateral, but Lehman could not provide it. By September 2008, the market concluded Lehman was insolvent, and no one would trade with it. The failure itself was catastrophic, but the cascade was worse. Lehman's bankruptcy put all its derivative contracts into default. Institutions that believed they were hedged suddenly were not. A European bank that had bought protection from Lehman now found itself fully exposed to billions in mortgage losses. A pension fund in an interest rate swap with Lehman could not collect its payments. The system's interconnectedness meant Lehman's failure instantly created balance sheet holes at hundreds of other institutions. Some failed. Others stopped trusting anyone, freezing the credit markets. AIG's collapse was more revealing. It showed how a single derivative type, credit default swaps, could destroy a company with $1 trillion in assets. AIG's financial products division had sold $500 billion worth of CDS contracts, mostly insuring banks against losses on mortgage-backed securities. AIG collected premiums, assuming the risk was minimal based on historical data showing national housing prices had never fallen. When they did, AIG owed tens of billions it did not have. Its credit rating was downgraded, triggering contract clauses that required AIG to post more collateral immediately. It could not. The Federal Reserve stepped in with an $85 billion emergency loan in September 2008. It was not enough. By March 2009, AIG had received $180 billion in government support, the largest bailout in history. But analysis of the AIG bailout shows it wasn't a bailout of AIG. It was a backdoor bailout of its counterparties, the major banks. Goldman Sachs received $12.9 billion through the AIG rescue. Merrill Lynch received $6.8 billion. Bank of America, Deutsche Bank, and dozens of others received billions. Government funds were funneled through AIG to ensure these banks did not suffer losses on the derivatives they had purchased. This revealed the operational truth of the derivatives market when it fails. The losses are transferred to taxpayers. The banks that create the risk are rescued, because allowing them to fail would crash the entire system. The total cost of saving the system in 2008 was staggering. The U.S. government committed $700 billion via TARPs. The Federal Reserve created $4 trillion through quantitative easing, globally. Other governments and central banks provided an additional $25 trillion in loans, guarantees, and support. The total commitment reached $29 trillion, nearly twice the U.S. economy at the time. All this was required to stabilize a derivatives market of $60 trillion. The system was saved, but the underlying flaw that derivatives had become too large and complex to control was not addressed. The Dodd-Frank Act of 2010 was presented as the solution. It mandated some standardized derivatives be traded through central clearinghouses, theoretically reducing counterparty risk by having a central entity guarantee trades. It required more reporting, but it did not cap the market's size. It did not ban the most dangerous derivatives. It did not solve the fundamental problem of banks using extreme leverage, backed by depositor money and taxpayer guarantees. Within a few years, lobbying efforts had successfully weakened even those modest reforms. The derivatives market resumed its growth. By 2015, it exceeded $600 trillion. The market that was $60 trillion in 2008 is now $600 trillion, 10 times larger. To put this number in perspective, global GDP is approximately $100 trillion. The derivatives market is 6 times the size of the entire world economy. The numbers imply that if even 5% of these contracts fail, it would generate $30 trillion in losses. This is 3 times the total cost of the 2008 bailouts. There is no existing mechanism, amount of money, or policy tool that could absorb losses of this magnitude without collapsing the global financial system. The composition of the market heightens the danger. The largest category is interest rate derivatives, accounting for over $500 trillion. These are bets on interest rates. Banks use them for hedging, but also for speculation. When rates are stable, these appear safe. But when rates move rapidly, as they have over the last 3 years, the risk explodes. The Federal Reserve raised interest rates from near zero in 2021 to over 5% by 2023, the fastest hiking cycle in 40 years. This move created winners and losers. The losers' losses are currently sitting on bank balance sheets, often hidden by accounting rules that allow banks to avoid marking these positions to market value. The second largest category is credit derivatives. At $50 trillion. This includes the same credit default swaps that destroyed AIG. Regulators promised to clean up this market after 2008, but the record shows it is still active. Banks and hedge funds still use credit default swaps to bet on defaults. The difference now is that corporate debt has surged from $2 trillion to over $10 trillion in the U.S. alone since 2018. Much of this debt was issued at low rates. As companies refinance at higher rates, defaults are expected to rise. When they do, the credit default swaps written on their debt will trigger payouts. If enough companies default simultaneously, the institutions that sold this protection will face losses they cannot absorb. This is the AIG scenario, poised to repeat. But in a market where the Federal Reserve may be unwilling to print another $180 billion, currency derivatives represent another $100 trillion, vulnerable to exchange rate shocks. The U.S. dollar's 80-year dominance as the world's reserve currency is eroding. Countries like China, Russia, and India are increasing trade in their own currencies. Saudi Arabia is accepting yuan for oil. If the dollar weakens significantly, currency derivatives will experience violent moves. Banks whose models assume dollar stability will find themselves on the wrong side of trillion-dollar bets. The unwinding would cascade, as currency values affect all other markets. But the most insidious aspect of the modern market is its complexity. Banks did not simplify after 2008. They created derivatives of derivatives. It is now possible to buy options on credit default swaps, or swaps based on indexes of other swaps. This nesting creates exponential leverage. A small move in the underlying asset can trigger massive changes in the derivative pyramid built on it. Internal risk models cannot price this. The models, by design, assume normal market conditions, continuous liquidity, and solvent counterparties. In a crisis, none of those assumptions hold. Liquidity vanishes, prices gap, and counterparties fail. The models break, and losses exceed all predictions. The situation is made more fragile by the concentration of these derivatives in a small number of institutions. In the U.S., 4 banks hold approximately 90% of all derivative exposure: J.P. Morgan Chase, Citibank, Bank of America, and Goldman Sachs. J.P. Morgan alone has over $54 trillion in notional derivative exposure, 180 times its total capital. This concentration means a miscalculation at one bank risks the entire system. This is not diversification, it is systemic fragility. The biggest banks are all making similar bets, responding to the same signals. The derivatives market is not evenly distributed. It is concentrated in 4 American banks that together hold over $500 trillion in notional exposure: J.P. Morgan Chase, Citibank, Bank of America, and Goldman Sachs. These are the same institutions bailed out in 2008. Understanding their risk requires looking past notional values to leverage and interconnections. J.P. Morgan, the largest holder, has $54 trillion in notional exposure, based on recent regulatory filings. Its total assets are 3.7 trillion. Its equity capital is $300 billion. This means its derivative exposure is 180 times its capital. The bank's public position is that notional value overstates the risk. As most positions are hedged, JP Morgan claims its net current credit exposure is only $50 billion. This is the same argument Lehman Brothers and AIG made before they collapsed. Their hedges worked until they didn't. When counterparties fail, hedges disappear, and gross exposure is all that matters. Citibank holds $48 trillion in notional exposure against $2.4 trillion in assets and $200 billion in capital. Bank of America holds $37 trillion against $3.1 trillion in assets and $280 billion in capital. Goldman Sachs holds $47 trillion against $1.6 trillion in assets and $120 billion in capital. Together, these four institutions carry $186 trillion in derivative exposure, nearly double the global economy. A catastrophic error at any one of them could generate losses far exceeding its capital, rendering it insolvent. The standard defense is that these institutions use sophisticated risk management. But sophistication does not prevent disaster. It often enables it. Complex models create false confidence, encouraging larger bets. Long-term capital management. LTCM. The hedge fund that collapsed in 1998 employed two Nobel Prize-winning economists and the most advanced models in finance. It still lost $4.6 billion in 4 months. Its failure required a $3.6 billion Federal Reserve-arranged bailout because it threatened the entire system. LTCM's derivative exposure was $1.25 trillion, a fraction of what the Big Four banks hold today. The interconnections create a web where each bank's survival depends on the others. JP Morgan might hedge its rate exposure with Citibank. Citibank might hedge with Bank of America, which hedges with Goldman Sachs, which hedges with JP Morgan. On paper, the positions offset. In reality, it is a circular dependency. If one bank fails, the others face immediate losses on their hedges. This was the 2008 dynamic. Every bank had exposure to every other bank. When Lehman fell, they all teetered. The post-2008 central clearing requirement was meant to solve this by having a clearinghouse guarantee trades, but this only covers standardized, exchange-traded derivatives. The vast majority of the $600 trillion market is over-the-counter, customized contracts privately negotiated between banks. These bilateral contracts carry the same counterparty risks as in 2008. If Bank A fails, Bank B faces the loss. With no clearinghouse backstop, the reforms, while appearing substantive, did not fundamentally change the market's structure. Even the cleared derivatives pose a systemic risk. The clearinghouses themselves are now too big to fail. If a clearinghouse faces losses exceeding its default fund, it could fail, taking down all its members. Clearinghouse rules allow them to tear up contracts or seize assets from surviving members to cover losses from failing ones. This means even a prudently managed bank could face massive losses if other banks at its clearinghouse fail. This structure mutualizes risk in a way that subsidizes reckless behavior by careful banks. The market's 15-year survival since 2008 has created a dangerous illusion of stability. But this survival was enabled by an unusual period of low interest rates, low volatility, and central bank intervention. That period is over. The triggers for the next derivatives crisis are already visible, and several are likely to activate within 12 to 18 months. The most obvious is interest rate volatility. Over $500 trillion in derivatives are tied to interest rates, which have just seen their most violent swings in 40 years. From 2008 to 2021, near-zero rates allowed banks to take huge, stable positions. When the Fed hiked rates from 0 to over 5% in 18 months, starting in 2022, it created immediate stress. Banks holding long-duration fixed-rate assets saw their value plummet. This was visible in the 2023 failures of Silicon Valley Bank, Signature Bank, and First Republic. But most of the losses remain hidden in derivative positions that accounting rules permit to be held off-market. The problem intensifies if the Fed must choose between fighting inflation and preventing recession. If inflation remains high and the Fed keeps rates high, more institutions will face derivative losses. If a recession hits and the Fed cuts rates, institutions on the opposite side of those bets will face losses. Either scenario creates losers large enough to threaten solvency. If the Fed flip-flops, the volatility alone could break risk models, triggering margin calls and forced liquidations. Commercial real estate. CRE defaults are a second trigger. Over $2 trillion in CRE mortgages must be refinanced in the next 24 months, at rates triple their original financing. Many owners will default. Those defaults will trigger credit default swaps written on commercial mortgage-backed securities. Institutions that sold this protection will face unexpected payouts. The CRE mortgage security market is $600 billion. While defaults here may not crash the system alone, they could generate tens of billions in payouts, weakening banks and starting a cascade. European banking stress is a third trigger. Credit Suisse collapsed in March 2023. Deutsche Bank, with over $40 trillion in notional derivative exposure, faced a spike in its own credit default swaps as investors worried about its solvency. The system is global. If a major European bank fails, it will trigger losses at American banks through their derivative contracts. A failure in Frankfurt directly impacts a balance sheet in New York. Sovereign debt crises are perhaps the most dangerous trigger, combining credit, currency, and interest rate risk. Japan's government debt exceeds 260% of GDP. It has kept rates near zero for decades, but inflation is making this unsustainable. If Japan is forced to raise rates, or if investors lose confidence, the yen could collapse and its bonds could default. Global derivative exposure to Japanese bonds is enormous. A Japanese debt crisis would trigger losses at every major bank. China faces a similar risk. Local government debt exceeds $13 trillion, much of it hidden. Its real estate market, 30% of its economy, is collapsing, with major developers like Evergrande defaulting. As these losses spread, credit derivatives on Chinese debt will trigger. Western institutions have exposure to China through these contracts. The final trigger is geopolitical, a major conflict disrupting trade, energy, or currency markets. A China-Taiwan conflict would shut down semiconductor production. An escalation in Ukraine could create energy shocks. A Middle East conflict could send oil to $200. Each scenario creates market volatility that derivative models are not built for. Because of the inherent leverage, small market moves create large losses. The most critical finding of this investigation is that when the $600 trillion derivatives market fails, no bailout is possible. In 2008, governments committed $29 trillion, 40% of global GDP. It required unprecedented coordination and political will. It barely worked, and it led to a decade of weak growth and exploding government debt. Today, the market is $600 trillion. A 10% failure rate implies $60 trillion in losses, more than twice the 2008 rescue and over half of global GDP. Governments do not have $60 trillion. They are already heavily indebted. The U.S. debt is $36 trillion. European governments are in similar positions. Japan is at 260% of GDP. None can borrow $10 or $20 trillion more. The bond markets would collapse. Central banks could print the money. But the consequences are known. The Fed's balance sheet grew from $800 billion to $9 trillion post-2008, contributing directly to the worst inflation in 40 years. Printing $20 trillion to cover derivatives losses would trigger catastrophic inflation. The dollar would lose value. Imports would become unaffordable. Real wages would collapse, followed by social unrest. Printing money to save the financial system would destroy the currency, which is a worse crisis. The political will for a bailout is also gone. In 2008, a shocked public complied. That acceptance is gone. The last 15 years showed bailouts saved banks, not people. Wages stagnated. Housing became unaffordable, and wealth inequality exploded. The next crisis will meet high political polarization and low institutional trust. Populist movements are demanding an end to bailouts for the wealthy. An attempt to bail out banks again would likely face ungovernable resistance. The too big to fail doctrine of 2008 has become too big to save. The banks are larger and 10 times more leveraged. Their interconnectedness is global. The resources to save them, government borrowing capacity, central bank credibility, political will, are depleted. The system has outgrown its rescuers. There is also a mathematical problem. Bailing out a bad mortgage involves buying an asset that may one day recover value. A derivative is not an asset. It is a contract. When it fails, one side loses. One side wins. Bailing out the loser is a direct wealth transfer to the winner, the speculator, for no productive purpose. It makes no economic or political sense. Furthermore, the market's opacity makes it impossible to know who to bail out. When Lehman failed, it took months to unwind its derivative book. In a systemic crisis, with multiple failures, the tangle of contracts would take years to sort out. The real economy would be in a depression long before the true losses were even calculated. You cannot bail out a system you cannot understand. The only rational policy response would be to let institutions fail and manage the consequences, rather than prop up an unsustainable system. This would mean bank failures, pension losses, and a severe recession. It would be catastrophic. But attempting to bail out $600 trillion would be worse, adding currency collapse and hyperinflation to the disaster. So, the investigation concludes we are sitting on a $600 trillion derivatives market, 10 times larger than in 2008, concentrated in 4 banks, whose failure is systemic. We face multiple triggers in the next 12 to 18 months, with no viable bailout mechanism. Warren Buffett's 2003 warning was accurate. The response was not to disarm, but to build bigger weapons. The crisis is coming. It may be triggered by interest rates, commercial real estate, a European bank, a Japanese debt crisis, or a Chinese collapse. The specific trigger is irrelevant. The system's fragility ensures any significant shock will detonate it. When one bank fails to meet its derivative obligations, the cascade will begin. Hedges will be revealed as worthless. Margin calls will force selling. Clearinghouses will face insolvency. Within days, every major financial institution will face unmanageable losses. The government will announce emergency measures. The Fed will open lending facilities. Central banks will coordinate. None of it will work. The problem is too large. You cannot bail out losses that exceed half of global GDP. You cannot print the money without destroying the currency. The math does not work. What comes after is unknowable. A derivatives cascade would unfold in days, faster than policy can react. Bank accounts would freeze. Credit cards would stop working. Pension funds would be wiped out. The economic disruption would lead to social chaos as supply chains break and unemployment hits 1930s levels. This is not speculation. It is pattern recognition and mathematics. A $60 trillion market broke the economy in 2008. That market is now $600 trillion. The bailout capacity is gone. The triggers are appearing. The cascade is inevitable. The only questions are timing and magnitude. The evidence suggests sooner and larger than anyone expects. Financial weapons of mass destruction, once built, are eventually used. Derivatives are no different.